Okay, so the balance sheet, what we're going to forecast is basically your current assets and non-current assets, your liabilities, and your shareholder equity, your share capital. What we usually do is we don't forecast this, but what we forecast is what we can do. So can anyone tell me, how do you get your retained earnings when you forecast your balance sheet? So where is it from? Yeah, okay, correct. Net income. So whatever retained earnings, let's say for the past 5 years, I have retained earnings of 100K. Then 2022, I have another net income of 20K. So it would go to my retained earnings of 120K. So my retained earnings is essentially all of the net income combined for the past 6 years. Let's say my company started 6 years ago. So that is what essentially it is.
Oh, no. Yeah, let's continue.
Okay, so when it comes to forecasting your current assets and your current liabilities, there's something called working capital. Essentially what it is, it's just the current assets minus current liabilities. And based on the accounting terminology, your current assets is a debit, and then your cash is a credit. So, okay, how do I explain this? Debit means whenever you have an increase in your current assets, let's say inventory, I have $500 and increase in inventory. What happens to my cash? Obviously, it declines, right? So that's how you balance debit and credit. The opposite is true for your current liabilities. Current liabilities is, let's say, I have an increase in $500 in account payable. So that is a $500 increase in credit. And then your cash, debit. Does anyone know why? Don't answer. This one also can answer. The other five.
Several say no. And like foreign cash, that's why it's like you need to pay them back. So you credit.
But why does my cash increase?
You're receiving cash.
You're not essentially receiving cash. So what you're doing is, let's say I have an account payable. When I owe this cash, but technically I haven't paid it yet. That's why it's debited. So it's not really receiving. It's basically me keeping the cash until a certain point where I owe it to you. Yeah, so this is a very important formula when it comes to trying to balance your balance sheet, which is what I will try to emphasize later. For the next part, we have your PPE. So your property, plant and equipment, very straightforward. Yeah. Okay, I'm pretty sure there's a lot, but I only know two. Straight line depreciation, and then there's the double straight line, and then there's double straight. So these two are the normal depreciation methods. For simplicity's sake, and from what I've seen so far, we only do straight line. Yeah, from my experience. Okay, so what we do, right, when it comes to PPE, is just your opening PPE, which is your starting property, plant and equipment, your starting long-term assets, minus the accumulated depreciation. So Chelsea looks a bit confused. Okay, so basically, right, let's say I have a factory that's 100K, and over the past 5 years, it has depreciated at, let's say, 50K. So that means my accumulated depreciation, 50K, 100K minus 50K, the net TPE left is 50K, which will be depreciated for the next 5 years at 10K. So that is essentially what this NDPPE is at a very straightforward kind of definition. When it comes to disposal of PPE, this is towards the end of your normal, let's say, your factory. You don't really want to depreciate it fully, you still want to sell it off at the end of its life. So that's when you will either let's sell it for a small amount to try to recoup it back. Okay, as for the last part, we have capital expenditure. So capital expenditure is essentially buying new factories, investing in new properties, investing in long-term assets, which are revenue generating. It's an important note to see that CapEx is always investing in long-term assets that are revenue generating. Need to remember this. Okay, debt schedule, this will be covered next. Okay, homework, but I'll just go through it very quickly. So debt schedule is essentially, let's say a company has a debt of 500K and they have a repayment amount, let's say 100K a year. So you have to kind of calculate 500K minus 100K minus 100K every year until it's fully paid off. The only difference is you need to calculate the interest expense for the net debt every year. So let me draw it out. We can see what is drawing. Okay, let's say the starting debt is 100K. Right? And we have a timeline here. So this is just 0, 1, 2, 3, 4. And let's say every year we pay 125K in terms of repayment. So 125K for the span of 4 years. So you have to slowly calculate the net debt, 500 minus 125, 265K, then 250K, then 125K. So what you have to do is forecast the interest expense. Let's say it's 10% every year for this amount. 10%. 10%. So interest expense, 275K, you have to pay 37.5K interest expense. This will be 25K, this will be 12.5K. So now you can see it starts to make sense, right? Basically your debt, you have to forecast the interest expense, which flows back into your income statement, which is your EBT, yeah, EBT, 94. Yeah. Okay, so how get it so far? Confusing or digesting. You need to slow down.
Yeah, the interest expense part of the fund. Sorry, I thought the interest expense part of the fund. Like the 0 to the first year then you start.
Year 0 is what I'm talking about. Let's say you forecast in 2022. 2021, the interest expense. So it starts from 2022, year 1. Yeah, you get what I mean. Okay, so I think for time being, most all of you just open up your SIG models if you all haven't opened yet. Okay, yeah, start with this. Yeah, I forgot which one. This one. For Azel also open up your model lah.
Just to share something extra, right? What you all will see in the balance sheet, right? Is that some line items, right? Will be dealing on this your beginning balance, right? And your ending balance, right? There's a relationship from the first year to the next year. For example, for this, right? Let's just say it's FY20, and then you have FY23, and then 24 and so on. So what happens is that, example, for FY22, right, your ending balance, let's say 100. You'll be go into your FY23, the beginning balance, and then you'll just for example, you just add like $10 onto it. Then your ending balance will be 110. Then this 110, right? you will flow into your next year's beginning balance. And then you add another 10 or 20 or whatever. Then you will flow again into the next year's beginning balance. So some of the line items that you will see this sort of relationship. So you need to understand which line items are going to be like this. So roughly or anyway, what will be happening for what are some examples of all these line items? Is your cash, is your PPE, is your retained earnings, your debt. Yeah, those are the main few line items. So this is just something for you all to take note of that you all should bear in mind. This is a basic formula. This is your beginning balance, then your whatever addition or subtraction, then your ending balance. So actually this pattern, right, there's a name, it's called a corkscrew. So you all can just go and Google. It's basically you just bring your ending balance over to the next year's beginning balance, and then so on and so forth. So this is just something to take note of that will happen inside your balance sheet and your cash flow, but not for your P&L.
Yep. Okay, so it's not an important part, but this is also really important when it comes to your cash flow statement. So right now, what we're going to do is we're going to do our net working capital forecast, which is under your BS drivers. Okay, wait. Could have done for me. So let me explain it real quick. So when it comes to forecasting your working capital, okay, I always explain it current assets, current liabilities. So when it comes to forecasting working capital, there are about 3 things that you need to forecast. Your payables, the receivables, your inventory, and then the rest is just like other versions of what these 3 items are. But these 3 are your main bread and butter when it comes to any financial statement. So for inventory days, what we're gonna do is basically it's the formula where let's say it's your inventory days over 365, and you multiply it by your cost of goods. Can anyone explain to me why it's cost of goods? Can answer? Check out. Azer, you want to answer also can. And making sure you're paying attention in class. Come on. Wanna try? No, why does inventory right fall in terms of this formula?
In your sell the goods, then you size return.
Okay, that's good. So essentially, right, what Alvin was saying is inventory obviously will fall under your cost of goods because technically part of the cost whenever you purchase inventory and you sell it, right, it will definitely be part of your cost of goods. So it cannot fall under in revenue because the item when you bought, right, for your inventory is always at cost. These are very important note. You're not selling it at revenue, you're not selling it at sales, you're selling it at cost, which is why it falls under cost of goods. Okay, so what? Yeah. Okay, so the next part, right? So what I want you to do is with this formula, forecast the inventory days. The answer is already there, but I'm not going to show you the formula, just try to figure it out on your own based on this. Yeah. I'll walk around and take a look. Azer also try to forecast the inventory days of sale. And so the other person there. Okay, so for Kimberly, if you can see the screen right now, just try to forecast the inventory, right? Try to get the number over there based on the formula. Inventory days over 365, then times the cost of goods. You try to. Yep, here. Okay, so you can see it as well. No, wait, so let me look around. We'll take like 2 minutes for this, then we can move on to the next part.
Yeah, I think you just enough. I think we will need high level testing. Basically, one lunch purpose of and just sure. So it's like 5 days of physics science. Right, sure. So you get
Hazel, can you see the whiteboard? Or Kimberly? Can okay. Okay, so we'll move on to the next part, which is your receivable days.
Yeah, Rogers.
Yeah, because this is using historical to get the numbers. Then I'm not sure that if you apply it, basically they use these numbers, right? Form these numbers as forecast. These numbers sometimes they use minimum maximum median or
Okay, I'll go move on to the next part.
So it's convenient.
I move on to the next part. Okay, so the next part, right? So what I said earlier, there are three important bread and butter when it comes to your working capital. You have settled inventory, now we're left with receivables and trade payables. So for account receivable, the formula goes like this. Your receivable days out of 365 multiplied by your revenue. So again, I'll ask the question, why does receivable days fall under revenue? Why not cost of goods? Can answer. Chelsea, Ryan, Robin, Giovanna. Give it a try.
The receiver is like how much you are going to get. So it's basically how much you get.
Yeah,
It's like you sell it at the
correct. Essentially, it's the opposite of this. Inventory is what you purchase at your cost. Receivable is what you purchase, what you sell at, which is your revenue, which is why receivable days falls under revenue. So I hope this makes more sense to you. Inventory is always cost, receivable is always revenue. Because receivable is what you sell, inventory is what you buy. Always remember this point, very important. So for the next part, account receivables, try to forecast also the answer is there with the formula here. For Kimberly there, I will try to get the revenue out. Revenue.
Depends on what. What's the base rate?
Yeah, so for Kimberly, the revenue is over there. You can also give it a try, lah. So how to get the Excel file? Jason, how to get the Excel file? The general member wants to get the Excel file. Kimberly, it's on the website, the SUSS Invest website. They can take a look. It's on the research section. Then you can probably try to find it there, lah. Okay. The password is emailed to you, right? Yeah, the password is emailed to you, so you can check your email. Yep. Okay. So I'll give you all about 2 minutes to try this, lah. Okay, so for the other receivables part, right, very straightforward. Similar to IS forecast, just do a percentage of revenue for your forecast. Then after that, just multiply it up. It's very similar to IS forecast, just do it same way. So for Kimberly, who might miss last week's lesson, basically other receivables, what we're doing right now is we're just taking it as a percentage of revenue. So what it means is whenever I want to sell something that's other receivables, right? Because receivables is still technically a sale. I just have to take it as a percentage of my total revenue. So the 10% is just an assumption. I assume like for the next 5 years, other receivables will be 10% of my revenue. And that's how I forecast it. Okay, I'll give you all like another 2 minutes to settle these two.
Basically, so it's a so basically
Kishan, you help me settle the so that I move on to the next. Dr. Ryan, just focus on this. Okay, so the next part. The very last item of your bread and butter for working capital is your payable or account payable. So the formula goes like this. Your payable days, our 365 multiplied by our cost of goods. So same question again. I'm gonna ask this every time. Why is payable days under cost of goods? It's very similar to inventory. One hint I can give is when you have an account payable as a business, right? What do you purchase the item in? That's my thing. Yeah, correct. Yeah, so what Giovanna says, correct? Your payable days is what you owe to the supplier at a cost for inventory. And that is why it falls under your cost of goods. Yeah, very straightforward. So, okay, so for the last part of your working capital, just help you forecast the account payable based on this formula. Payable days over 365 times the cost of goods. And give like 2 minutes or so for this. Okay, so I'll give you another 3 minutes. Wages payable is very similar to accounts payable, just follow the same formula. Then other payable will be a percentage of your total operating expenses. So basically it's the same as your IS forecast, the way you do it. Just take a percentage.
I think yeah.
Is it on your side okay?
Yes.
Sorry, okay, yeah, sure. Can you give me a moment? Two, three, yeah.
Number.
Yeah, let me know if this is okay. The password here. That's how I agree. Okay, we can move on to the next part, the more fun part, which is balancing. Okay, so I'm gonna go straight into balancing for this part, so that you can have a rough idea of how you're gonna balance your 3FS. Okay, so the first thing I always like to do when it comes to balancing your 3 financial statements is to link your cash and cash equivalents to the end year of your cash flow statement, which is your ending cash balance. Sorry,
Your ending also gives one.
is linking first.
Or it is.
You link from previous year. Yeah. Yeah, where is it? Yeah.
Or yes, okay.
Yep. Okay, so what I need all of you to do first right now is for the balance sheet, just make everything equal to the previous year for the rest of the line items. So what I mean by that is very simple. Where's my mouse? Equal to previous year. Just do this for everything. If you want me to do it, quite straightforward. Right. You go, I see. So we just yeah.
What's your wages payable?
Wages payable is the same as account payable form. Exactly. Yes.
You time staff expense.
Staff expense.
Kimberly, are you able to get the website logged in? I think it's good for you to have a model. Oh, so the password doesn't work. Hey, Jian, text me the password. Maybe I typed wrong. Sorry, I okay, I didn't really have enough sleep. Try this. I'm sure I put capital instead of research.
I thought
I put capital.
SIG
SIG capital.
Oh, okay. Okay, you're equal to previous already, right? Yeah. Okay, nice. So basically what you have to do for this step, right, is just make all the line items for 2023 equal to the previous year. But remember to not do it for the values such as basically the bold black, right? Don't make it equal to previous year. Okay, so for the next part, we'll go all the way to our inventory first. So equal to previous year. Then make it equal to working capital schedule, which is our inventory here. Oh, okay. So a good habit, right, is whenever you want to start balancing, make sure all the line items are yellow. Sorry, wrong one. Here. So a good habit is to make everything yellow lah. So what yellow means is I haven't adjusted the line item there. So once it's adjusted, then you slowly make it white again. So that's how you do it. F4. Yeah. Wow, copy this. Wow, I don't even know that. Cash flow. Oh, ups. Okay. Okay, so once you equal the inventory from your balance sheet driver, right, your schedules. Try it. Yeah. You start to see that this is not balanced. See it so far? Okay, so why is it not balanced? Yeah, why is it 264? Ryan, you able to follow so far the lesson? Yeah, okay, so why is it negative? Why is it not balanced when I added the inventory? Yeah, actually, yeah, correct. Okay, so goes back to the entire accounting principle that I talked about previously. So when your inventory is a debit, right, which is an increase, your cash, your credit, which is decrease, right? Makes sense. So in this case, what happened here? What happened to the inventory? Decrease, right? So if your inventory decrease, what does that mean? Just a swap. So right now it's your cash, debit, your inventory, credit. So in this case, what must you do to your cash? Yep. So that's how you do it in the cash flow statement. So scroll all the way down to a cash flow. Under working capital changes. So since you're adjusting this, right? change it back to white. Equal previous year minus your forecast year. Congrats. You're on your first step of balancing a balance sheet. Okay, so if you get it so far, the same principle applies to account receivables because it's also current assets. So do the same thing for your account receivables also. For your account receivables and your other receivables, it's the same principle. So I'll give you 3 minutes to try this on your own, then I'll go through how to do it also. So where's the drastic? Oh, everything. So basically something. Then that changed. Basically, okay, so I realized some of the models, right? The model didn't really link it for you. So what you should do, your beginning cash balance, you equal to a previous year. because the beginning cash balance, remember the corkscrew, will brought over to your end balance, which is your forecast here. So your ending cash balance equals to this now. I mean, your beginning is equals to this. Your net change is essentially the sum of your financing, investing, and operations from your cash flow statement. And at the end, you just have to do a plus between the two. Yeah. Okay, so if for those who might be lost, what I just told the rest to do is essentially, right, your ending cash balance must be equal to your beginning cash balance must be equal to your previous year's ending cash balance. And that can be found here, which is here. Because at the end of the day, when you boil it down into your profit, right, the final line item will definitely be your cash. So you bring it over to the next year. And then once you equal that, all you have to do is just do a sum of your cash flow from operations here, your cash flow from investing here, your cash from financing here, to get the net change in cash. And then after that, you do a sum between the both. So other table was just Oh, I don't think that. Oh. So just now I did try to James, Aza can follow. I know James just joined, but then what we did was working capital, just forecasting, now we're balancing. Were you able to follow the balancing part?
Sorry, can you say again?
I know you missed out on, so what we did previously, right? We just forecast working capital. So right now I move straight to balancing the working capital. Were you able to follow?
Kind of. Rather sick to follow also. But kind of get it.
Okay. Aza can, right? Hello, Aza. Okay. Everyone okay so far in terms of the balancing? We move on to the next part already. Ryan, okay? He's on the teaching. Okay, okay. So now we're gonna balance the account payables. So this scenario, I'm gonna go through the accounting principle again. Okay, so let's say you have a debit in your account payables. Then you have a credit. You have cash. Sorry, wrong. You have a debit, cash, and you have your credit, accounts payable. So I understand this part so far, right? So try to contextualize in terms of previous year and next year. So let's say I have increase of 500. Okay, let's say 2021, my accounts payable is 500. 2022, my accounts payable is 1000. What happens to my cash based on this principle? Go down. Why go down? Okay, so I give you a hint. I owe money. I have an increase in the money I owe, but I haven't paid yet. So what's my cash? Yeah. So a cash will be increase of 500. So once you get this principle so far, that's all you have to do for your cash flow statement. Okay. So this time we go to your accounts payables. Okay, here. Same thing. Wait, balance sheet. Make it white first, because you're changing it. Equal to your working capital schedule. Which is here. Okay, so based on that formula based on the principle that I've shown you just now, try to do that in the cash flow statement here, which is your account payable. Try to contextualize it. Every time you're doing you're trying to balance, right? Try to contextualize based on the accounting principle.
Yeah, sorry.
You should get this answer now. James can follow. Hello, James.
Hi, sorry, yes, I'm here.
Can you can balance the AP.
Oh, yes.
Kind of what is kind of.
Just looking at it for now.
Okay, okay. Try to do it lah. It's quite simple. You try to do account receivable, account payable first. At least try to balance this part, then you got your working capital set already. Also for Kimberly, if you are unsure of any parts, just let me know. Then I will revisit them again. I know it's quite difficult if you're seeing this for the first time. Okay, give you another 2 minutes now. So, in this case, what? Try to why is it? Not in terms of try to explain to me as if you are accountant. Why is it good? Good explain. So when you're cash harvesting, right? What does that mean? Yeah, so accounting. So in this case, but in this case, what you said now, your accounts payable is so that means you continue to month. So
basically all the things like language reference to minus
okay, so if you all got payable so far, try to do it for the same line items, which is wages payable and other payable. It's exactly the same principle. Just remember the accounting principle and follow it that way. Yeah, so just for the rest of these line items, other payable, wages payable, accounts payable, same thing. I got it already. Yeah. So, congrats. This is not the yeah, it's just I just need to understand based on the context. Okay, that side. Okay. I think for now we take like a 5-minute break. I will try to help out the other groups also. Then for those in the Zoom chat, just feel free to voice out any issues that you face lah, or you want me to revisit any parts. Yeah. Okay, so the next part of this lesson, we're going to go through the depreciation schedule.
Where? Oh, that's like you they have a
Okay. Okay, so I'll explain the theory behind the depreciation schedule first. And I guess okay, so let me explain it. Imagine I'm a business and imagine I'm a tuition lab, I have a table. So one table, one student. So that is considered my long-term asset. So I have one table here. And this is as of 2021, one table. And my depreciation for this, the life is 5 years. Depreciation is about, let's say, $10. Lifespan is about 5 years. The value of this table close to $50. Simple stuff, right? So just do a straight line. Starts from here, depreciates, $10, $10, 10, 10. Understandable, right? Simple straight line depreciation method. So my net PPE, so it goes like this: beginning, then ending. Corkscrew effect. This is for your PPE. Starts with $50, ends with $50 for year 0. So you move it next year, $50, depreciation. I add depreciation for my ending. So now it's $40. All the way continue 40, 30, 30, 20, 20, 10, 10, 0. Right? 10 and 0. Get it so far? Simple concept, right? Understand, right? So this is basically the start of your depreciation schedule. You just need to forecast your current PPE, which is your 2021 PPE. It's in your financial statements there. Then forecast the depreciation like that. So here's where CapEx comes in. So this time I want to expand. So I said CapEx is revenue generating long-term assets, right? I want to get another table. So this is my second table. Second table, also I bought it at $50, for example. So my question is, where will the depreciation start? So 2021 is for my PPE from last year. Now 2022, I bought a new table. So where does the depreciation start? Yeah, 1 year later, right? So this is out, right? This time, this is table 1, and this is table 2. Same thing. $10, $10, $10, $10. The only difference right now is the capex for this year will be added to my PPE, which is here. Kind of understand so far. So in this case, your beginning is $40, right? You add your capex, your new table, your second table. So $50 plus $40, that's okay, follow so far. So in this case, your accumulated depreciation so far for year 2 is $20. Can understand? So what we see here, right, on your financial statements is a very brief, basically it's exactly the same as this. You forecast your capex, you find the depreciation for that capex, and you do it in a waterfall way. Okay, so let me try something else. I have a third table now.
So the net is like minus 10.
Yeah.
That's what you're trying.
So just the total PPE, which is your table 1, your table 2, then you minus the depreciation for table 1, table 2. That's it. Right, can follow? I mean, I explained to you this last week, right? So this time, third table. Run me through how to do third table. Same value, $50. I bought it at 50.
Find the balance for pay plus $20.
Okay, so here is it.
So you start 1 year with the cost of
So here is it.
the cost of
Across out here. Okay.
so
So
start at all.
so I start here. So what's the depreciation?
$30.
Okay, so what is if my PPE here is $90? Landing. What's the PPE here?
That was minus 20. So it's 70 for
40,000.
then you take 70 plus each. So that's the each for paying.
Okay, correct.
So 150 then minus $30. Then you get 90.
Exactly. You get it so far? Giovanna, okay. 100%. Okay. So if you get this right, basically you can do your own depreciation schedule. I don't even need to show you how to do it. Just follow this concept. You should be able to do it on your own. So I won't go through how. I'll give you about 10 minutes to try this on your own. Follow this concept. So the first step is always remember depreciation for your net your 2021 PP. The capex you focus later. Just focus on the one that you have right. Yeah. Okay, so the eyes are much right. Nice. Like, then just do that.
Yeah, capex is your project, so your contract. So you have two different items right now. Your existing. So we should just stick to the one. Your one is your existing, your people one. Your capex is your people two. So you know how much your people one. So like which one is the people, which one is the existing? Can I stick to it? Two rows. that you will is correct. So you know, this is your table one, right? How many years does it? How many years is it? 2.5, right? Right. So it's so for the implementation of existing yeah, right? 2.5 years. So next year, how much? Times 2.5. Right. It is. Okay. Then once you answer we must accept. So you fix it. So that's it. What's the formula? So that makes some sense. Picture of 5,000. Because now we're looking at your existing year. Now we're looking just at the depreciation of your existing. Let's do it. These are your overall depreciation. Okay, but before we continue, we realize something. Where are your depreciation? It's 2,000, 2,000, 2,000. Does that make sense? Right. Yes, right now. Okay, then now we do the new table by with the number new table. Right? So you see this is based on a revenue number. Okay. So they say so far they compute for you that then forecast. This is the number that they for something up 20% of the revenue. So in year one, right? Now, okay, so this is also everything. So this one, right? So far, we always look at every financial year in a particular manner. When you look at waterfall, right, it's a horizontal manner. Okay, you see this part? It's 2023, right? So in 2023, we bought 3,600. What is the depreciation before that? So every year, right? So same thing. Yeah. Correct. Yes. Yeah. Yeah. So okay, you know there's the depreciation of your units, then your depreciation of X. That's your so this is right. So you got your depreciation and amortization. Something plus. Okay, then how do you get your net first? Like your net fee of this year starting. Right. It's enemy. It means we don't need the memories. also fine. Okay.
This depreciation is the so you have two different things, right? One is your existing city, then you also have existing throughout the years require right? So they actually separating different so you need these two numbers in there. Okay, the decision. Right. So I understand, right? Okay. So the depreciation of your existing area, the one that you have now, how much do you
Is your James okay?
have?
You're able to do the depreciation on your own, the schedule.
Do you want to see once you have the start of the year?
Yes, that one I'm fine.
Is it okay?
Yes.
Okay, sweet.
Yeah, right.
Put the camera there.
So you wanted to take
James
so
and
that's by
yeah, just now got one more. Yeah, James. She says she got one. Okay. So let me teach you a very quick formula so that you all don't have to do the sum, you know, the line item you sum, right? Then you minus the depreciation. So there's something called, okay, let me just write it down. I'll just do it here. Lah. So what you can do, right, is the mean formula. You just do it here. Lah. Mean of your depreciation, let's say your PPE, right? Over your weighted average useful life. Okay, then the second one, you take the sum, you take your PPE minus the sum of your values here. So that's how you get the depreciation. So if you do it for the next year, right, like this thing, salah. Okay. It's basically very straightforward. You just find the minimum value between the depreciation. Let's say the depreciation is 2K, but the final value you cannot depreciate more than 2K, right? So you take the sum of your depreciation minus your PPE, which is 1K, the final value. So you take the minimum out of the two, and which is 1K lor. So basically, yep. It's a lot easier that way. In terms of it's more automatic lah. Can make mistakes, but it's more automatic once you get used to it. Do it. Yeah, so basically compare the values.
Basically, it's the same idea lah. So if your existing is 5K, right? How much does it exceed? Tier 1, tier 2. Yes, correct. With the exercise. Yes. You know what? You fix.
Just some.
Do you know this function? It's a shortcut. You want to FM? Basically, the remaining what is that? Basically, your summation, right, of all your depreciation, right, it's not exceed 5K. Makes sense, right? Yeah, so it is sorry, it's not so straightforward, because the weighted average life is just like straight. You know, okay, now we do based on this calculation, I want to spend a year, right? Just say like they spend $3,600. Some of I buy a new asset. The asset also has with the average life of 1.5 years. How much does the asset appreciate?
I want
Remember, you should do something. Control Z is correct. Why is it? Okay, so this one you put down. Because this one, right, it's doing the if you look at financials, but this one is new. And but when we look before we go on to the second one, right, you see that the first one, that row, right, got something to change one of it. Okay, other than the fact it's okay, other than the fact yeah. So yeah, do the same thing.
Basically this one should okay. Then I will always say G60. Because G60 is considered another course. So G60
Okay, so the answer is here. Try to get it. I'll give you guys another 5 minutes to do it. Then we can move on to how to balance the depreciation. I mean, how to balance PPE in your HFS.
What's your formula of G? The 418?
438, son.
Yeah.
So basically,
The year depreciation of the oh no, it's not. Okay, okay.
Because it includes your previous year, the net PPE.
Oh yeah.
You guys over?
So you remember you had your previous year remember the cost again. This one is your first one. Yeah, so you had that. Then you add your calculations. Then you minus your after that, right? So basically, same as this one, just register. So you see, just then we will minus some. So you want interest rate. Because the last so not right. So that's why right, we track box. The ones that are not. You see what I said? Yes. The formula
Okay, no, so first I'm not sure if
So this is your capex, this is your capex. So actually, the depreciation is your description of your depreciation existing to be. Okay, capex is like converting cash into long term, but depreciation is how much you actually losing value in the sector. So you need, so you know your depreciation is 2,000 plus this one, right? Because it's your existing. It's me, after the first year. So you take 2,000 plus one. So that's all. Yes. Because your 3,600, right? It's already a I think you're a bit like confused between this one and the first one. Later you minus the 3. So I just and show us
right now that's so basically one of the just things parts all the position. So this is table one. Table one is the position of position. Choose. Okay, so you should make sure that I understand. Okay. Okay, I think this one also we got precision. Okay, I think right now I can move on to balancing it. Ryan can got your depreciation schedule down. Set up. Confirm ah? Okay. Can move on to balancing now. Okay, so before balancing, we go to 3FS all the way up. Remember last week, you have a line item depreciation expense that was left empty. So right now, just go to your depreciation and amortization equal to the total depreciation for that forecasted year, then drag across. Once you all got that down, should be quite fast, right? Okay. Okay, move on to the PPE. Okay, so your net PPE, remember it was yellow, change it to white. Equals to a net PPE of that forecasted year. Got it so far? Okay. Scroll all the way down to your cash flow statement. Remember CapEx here? So CapEx, right? Under a cash flow statement, whenever you purchase new items, is it a cash flow in or a cash flow out? Out, right? Okay, so in this case, under your investing activities or CapEx, what is it? What was it? Cash flow out. Good, negative, yes, correct. So basically you go to your depreciation schedule, just equal negative capex for that year. That was so. Okay, so not right now, the last line item, depreciation and amortization. So this is a bit, in terms of the accounting principles, a bit tricky. Is depreciation a cash expense? It's not, right? Is depreciation a cash expense? So in this case, under your cash flow statement, is it a cash flow in or a cash flow out? In, right? Because it's not expense. Okay, so straightforward, just equal your depreciation and amortization to the depreciation for that year. And if your depreciation is a negative, just add negative in front so they report.
It's a balance sheet.
Yes, just balancing it out. Basically, your cash flow is how much actual cash you have. And depreciation is not it's a non-cash, right? So it doesn't make sense for you to. Yeah.
Either way, I think we can do podcast. Depreciation, I take that 5 year, example 5 year, depreciation 5 years, right? Depreciation okay 1 year, 1 year. But example this year 2020, right? In your capex, cash flow wise, minus 5K, right? So it doesn't make sense for your next year minus again. You know what I mean? So you don't double count. So that's why they add back. So your previous cash flow is count.
Okay, so that's how you balance your PPE. Very, very straightforward. Once you got your schedule down, once you understand the waterfall, it's really, really simple already.
Your capex, people you look at easier than this.
Basically, this one you can just cut. Because what's the
Yeah, so I thought it's like something, then I thought we were kind of something.
Because the walking is
Yeah, but I
Okay, so right now, right, once you balance, just drag it across. Your 3FS, right, just drag it across for the next 4 years. And we should see the rest of the years are balanced. We do it also. Yep. No issues, right? Everything's balanced for the next 3 years, next 2 years. Right. Okay, so settled. Today's agenda is settled. So right now we'll just finish up with the net income. So go to operating activities, your net income here. So people have different ways of, Ryan, you focus on this first. Yeah, okay. So people have different ways of how they balance. So what I like to do first, right? My steps were I do net working capital first, I balance, then I do depreciation schedule, then I balance again. So I can like kind of identify straight. But different people have different methods. If you're more seasoned, then you can just do the schedules first, then straight away do a forecast. So in this case, your net income, make it equal to your 3FS at the top. Here. Your net income here. Drag it across. Okay, you all got it so far? Net income. Sorry, wrong net income. That's correct. Yeah. Yeah. Is it okay, right? Hello, Isa. Oh shit, I'm muted. Oh no. I'm not. Okay, see. Hey, where James go? You got say where you go?
No, I don't know where he went.
Allow. Okay, so after your net income is equal to your forecast, right? In your cash flow statement. Where's my mouse? Okay. Go to your balance sheet. So in this case, where does net income belong to? Retained earnings. So what do? Yeah, simple. So you just go to your retained earnings, which is where is it? Okay, retained earnings plus your net income. And drag it across. Okay. Okay, so in this case, right, let me ask you another question. Why? So when you add your retained earnings, you add your cash, right? My question is, let me try to rephrase it properly. When you add it into your cash flow statement, why is it a positive for your net income? In this case, why do you have to balance your cash flow from operations and your net income? Because in the end, what is net income? That's my question. What is money? Yeah, that's basically the entire gist of it. Net income, the end goal, it will flow to your cash flow statement and then it will just become cash for the company. Yeah, so okay. We're done for today's agenda. Congrats on your first balance 3 financial statement. So what I recommend, right? Go home, or maybe if you have your own time, just try to delete everything and try to redo on your own time. And that's really how you learn. Yeah, and try not to refer. It should be okay, right? Everything, net income, everything settled.
So you're doing that.
No,
Me?
yeah,
My retained earnings is wrong.
your retained earnings wrong. Why?
E61 plus F.
Just add your retained earnings to your net income. Then your cash flow statement, cash flow from operating income, you add the net income also. You should balance straight really. Where James go?
Why am I different from you?
That should I do in this one.
Now you finish right?
Yeah, I think that's net income.
So for today, right, what Ezekiel has taught you, right, is how to finish the balance sheet schedules for working capital and PPE. And then basically if you think about it, right, your entire balance sheet is already completed except for your debt. So the debt, right, and your interest expense, right, that one is I've done another recording. So later we'll upload on the website. So that one, the debt schedule recording, right, your own self can watch. Then you update your model for the balance sheet, your debt, the P&L interest expense, and then the interest payments in your cash flow statement and your principal repayments in your cash flow statement. So this is the 4 things that should be updated after you edit your debt schedule. Yeah, so that's the thing that we will not cover today because it's too much content. So that one is just a recording your own self. You can go and watch on how to do the debt schedule. Then once you have done that, right, then the entire 3FS, right, everything is completed already. Then next week you'll be doing the DCF. So later just watch the recording and then complete the entire 3FS. Because next week the DCF, right, will be touching on what we have done in the entire 3FS. Yeah, so that's just something for you all to do. I think the debt schedule recording about 1 hour each, not very long. Yeah.
I think you guys can begin with your group discussions. If you have difficulty going through the balance sheet and the cash flow statement, I'll walk around and see and help you out. But right now I can start with your discussion. Okay, thanks, Isla. Bye.
Get off the recording.
Oh yeah, okay. Yeah, how?
There should be a stop button. Is there a stop button?
I only see stop share there.
On the top right. Don't have. I mean top left, sorry.
This is screen sharing.
Yeah. You're not sharing your screen again.
No, I mean recording.
Wait, what's the
Oh, okay, sorry.
Alright, cool.